Welcome back to the Williams Real Estate Channel. Tonight we are running through the macro market update for August 2025. As you know, we use the 18-year land cycle framework as our framework to look through this type of data as we'll run through in the future slides. And this is our lens that we use. We look through this data through the lens of the 18-year land cycle as we are on this blue marker. And as we go through these slides, it will give you a feel for where we are currently being on the blue marker, 12 months away from peak market, 2 years away, 18 months to 2 years away from the next land-driven downturn, where the likes of Brisbane, Perth, Adelaide, Darwin, and their respective regions will go through the brunt of the downturn, at which point the ripple effect will come back to the likes of Sydney and Melbourne, just like we saw in the recovery in the first quarter of the current cycle from around 2008 and onwards is when Sydney and Melbourne outperformed. So this is our framework, and to give you a flavour of where we are heading, we will start with the Australian GDP. As you can see, very sluggish in recent years as we are coming towards the end of the current cycle where land prices are so high, businesses are under strain, taxes are high, productivity is low. So it is all reflected in our gross domestic product being still low and probably won't rebound until the market recalibrates in the future years ahead. If we look at the unemployment rate, it ticks down slightly to 4.2%, but as you can see, it has been trending up ever since its trough in 2022, and will probably most likely continue to slowly trend up. And at some point in the not too distant future, something will trigger a run and a panic where businesses will then start to lay off people and shore up their balance sheets in preparation for the downturn, at which point we'll see the unemployment rate go through a spike, similar to what happened during the mid-cycle slowdown, also known as COVID. And if you look back at 2008 and the 90s, we also saw a strong spike in the unemployment rate. So once it starts to trend, history shows that at some point it will run in the coming years, but definitely a leading indicator we like to keep an eye on. The Australian inflation rate continues to moderate towards the RBA's target of 2 to 3%. The trim mean is currently sitting at 2.7%, and the all groups CPI is sitting at 2.1 as of June 2025. So that is, it's good, it's trending down. It is coming towards the RBA's target. Hence, with the unemployment rate slowly ticking up and inflation moderating, the RBA cut the cash rate to 3.6% in August. And their next meeting is scheduled for the 30th of September, so the end of the current month. So we'll wait and see what happens, whether or not they'll continue to cut, but definitely euphoria and speculation is starting to ramp back in the property market space as people are starting to flood back in. We have a 5% deposit scheme coming out of the federal government as of October 1st. So this is for all first home buyers are now eligible with no income limits. And the government will guarantee the loans, underwrite the loans, so there will be no LMI for these loans. So I'm already feeling it on the ground. The inquiries are definitely ramping up. People are looking to get into the market before this ultimate flood of first-home buyers are going to come in. And ultimately, that will all feed into the bottom end. So this stock that we've been buying in recent years is only going to get higher and higher demand in the future years ahead, especially in the markets that we've been buying in, as they've been more suppressed and they're coming off a lower base. So if you can get in before the mainstream rushes in, It's quite ironic that, I mean, the government's doing the best they can to keep propping it up and giving a go to the first-time buyers, but ultimately this is going to just feed on itself and create higher property prices in the years ahead. If we look at the US, we like keeping a track of the US because the US leads the 18-year land cycle, land market. Australia historically trails 6 to 12 months behind, and the US has rebounded in Q2 25 with a strong 3.3% GDP growth rate for the quarter. We also saw a slight tick up in the US unemployment rate to 4.2, so we're pretty on par with the US with their unemployment rate, and we'll continue to keep a strong key watch on this, as this is a key leading indicator for the inevitable downturn on the horizon once this starts to run. The US inflation rate is coming back off a base of 2.3% and is now hitting 2.7. The US has a target of 2%, and the Federal Reserve wants to see the inflation held consistently below 2 before looking to cut rates further, and it's sitting at 2.7. So this could be triggered from tariffs in the US, but also the amount of capital that's being reinvested back into the US as tariffs are being used to attract investment back into the US. So this could also be inflationary. Ultimately, this is going to be a key watch for the Fed to drop rates. Hence, the RBA would also be watching the Fed of what they're trying to do, as I believe the RBA will be reluctant to continue to drop rates until the US does. Otherwise, this will make a gap widen between our cash rate and the US federal funds rate. And if the gap continues to widen, that could be an issue for the Australian dollar, which could then be inflationary. So key data we're watching is the US inflation rate as a leading indicator for where our potential cash rates could go in the future years ahead. Trump has selected an interim governor. He wants low rates. He's a property guy. He wants to be able to refinance his debts and also the federal debt. Trump wants to see rates at 1 to 2%. So you can imagine what that would do to the markets in the final year or two of the land market if we start to see rates come down. So he's lining up to replace Jerome Powell, the current Fed chairman, as he won't drop rates. He believes that rates should be on hold, as they are currently on hold at 4.5%, which is probably justified, I'd say, with the inflation rate trending up. You probably don't want to drop rates, because if you do drop rates, that's only going to feed on itself and be more inflationary, and then you end up chasing your tail again and having to raise rates higher for longer and create a big euphoria and then an ultimate bust. So it'll be very interesting to see what happens over the next few months, as Jerome Powell's term is due to expire come May 26. So it'll be interesting to see who he selects to head up the Fed, and he's going to have obvious oversight for the rest of his term. And if we see a an oversight which allows him to push the chairman to drop rates, that will ultimately create a massive final speculation boom to the markets, not just property, but stock markets, and globally everything is just going to be off its heels, which is going to create the final euphoria FOMO setup, which is typically seen towards the tail end of a boom before the inevitable bust. So something we are definitely keeping an eye on is who Trump decides to select as the next federal chairman. Stock markets are pricing in future gains. They continue to rally to all-time highs in the Australian ASX, the Dow Jones in the US, and the UK FTSE 100. continue to hit all-time highs. So that is a leading indicator for coming to a close to a market top. And in the background, we continue to keep a good eye on DR Horton. This is a land and property developer, home builder in the States. Historically, DR Horton lost 66% over 2.5 years or 27 months from its peak in July 2005 to its low in October 2007 before the overall stock markets topped out and then went through the GFC. So this can also be used as a leading indicator as this company will be pricing in future reduced earnings in land values, which is a leading indicator for the coming land-driven downturn. To date, DR Horton has lost 11% over the last 11 months from its peak in September. It lost a good 30-40%, then started to rebound. I believe this is a dead cat bounce type of scenario, similar to what happened in around 2006. Lost a good 30 odd percent, then rebounded and then continued on its way to losing steam. So we'll keep a good eye on this in the future months ahead. And if this continues to trend down, then that is again another leading indicator for the coming land-driven downturn. Also, Berkshire Hathaway cash reserves hit approximate 344 billion US dollars as of Q2 2025. So Warren Buffett, one of the most famous investors going around, is sitting on by far his biggest stock cash reserves in his career. Before the GFC, it was around 25 billion. So he sees the writing on the wall. He's getting ready, and he's been cashing up ever since 2024 in preparation for, as he says it, blood on the streets. So timings now is to get prepared. And if you are looking to get into the markets, buyers beware. This is by no means financial advice or general advice, as I don't know your situation or circumstances, and I'm not a financial advisor. But if you want help buying an investment property and navigating through the turbulent times ahead, there's always a market primed for growth, as there's not one property market, there's multiple markets within markets and even types of property. When the market turns, come 27, 28, stock markets will get smashed, crypto will get probably wiped out to dust. Commercial real estate historically takes a 50 to 70% correction. Top end of town, so the mansions, the blue chip stuff, the new and off the plan, house and land packages, that all gets smashed. The demand will be shifting back to the likes of Sydney and Melbourne, just like they did in the GFC, in the affordable stock. And the affordable stock will rise in a time of crisis. Everyone needs a roof above their head, and the government continues to import mass migrants, and they all need a place to live. So the affordable stock will be in demand in the future years ahead. So buyers beware, don't get caught up in the fuss and the FOMO, because the fundamentals will be due to change in the years ahead. Until next time, thanks for watching.